$700 billion. That's how much companies like Microsoft, Amazon, Meta, Alphabet, and Oracle are expected to spend this year alone on AI infrastructure. To put that in perspective, that's more than the entire GDP of a developed nation like Sweden or Singapore. This rapidly growing spending spree has probably been the single biggest force driving the stock market over the past few years, and it makes sense. Investors look at this massive spending and assume that it's going to translate into significant future growth. And since these companies make up a large portion of the market, their spending has the power to lift the entire index with them. But there are clearly signs that this spending is now reaching extreme and, more importantly, unsustainable levels. Multiple companies like Meta, Microsoft, and Oracle have reported laying people off in order to offset their heavy AI spending. And many prominent figures in both finance and tech are warning that the spending is now reaching excessive levels. And to be fair, a lot of these stories do sound like what we saw towards the end of the dot-com bubble. Between 1996 and 2001, companies like World.com, Global Crossing, and the entire telecom industry spent roughly $500 billion laying fiber optic cable across the United States to power the internet. The spending was real, and companies that were supplying that equipment, like Cisco, were seeing real demand and generating real earnings growth. The stock market nearly tripled during that period, but in 2001, problems started to arise. The returns that were supposed to come from all of this infrastructure never arrived at the scale or speed that investors expected, and by then, the industry had actually built enough fiber capacity to handle 100 times the actual real demand. When that became clear, investors started to worry, and telecom companies began pulling back on their spending. Many of them even went bankrupt, and as a result, the stock market lost half of its value in just a few years. Now, fast forward to today, and we can see that data centers play the same role for AI that fiber optics did for the internet. And this time, it's the companies that we mentioned earlier, also known as the hyperscalers, that are building all of this infrastructure. And just like it did in the 1990s, all of this spending is trickling through the system and going towards the companies that are providing the equipment to make it all possible. That is companies like Nvidia and TSMC, for example. So in other words, as the capital expenditure from these large tech companies rises, all of that spending translates into real earnings growth for other companies that are building this infrastructure. And this is why S&P 500 earnings have gone almost parabolic over the course of the last year. Now, the question is whether things have already gone too far, whether these companies are finally going to start questioning the return on investment of all of this money that they're spending, which could put a massive dent in S&P 500 earnings just like it did in 2001. The most powerful way to actually look at this is simply to see whether the underlying economy today is seeing the same signs of weakness that it did in 2001. And we can check this by looking at something called the US manufacturing PMI. This is probably the most powerful indicator of the business cycle that exists. And if we look back over the past 3 decades, this PMI indicator has done a really good job of signaling where corporate earnings are heading. In 2000, for example, the PMI was already starting to roll over and even dropped below 50, which indicates a contraction in economic activity before S&P 500 earnings collapsed and the dot-com bubble burst. We saw a similar pattern leading into the 2008 financial crisis and again in the lead up to the 2020 pandemic. On the flip side, when the PMI is above 50 and going higher, it usually lines up with periods of strong earnings growth, like here in the late 1990s, in the mid-2000s, and in the 2010s. The reason for this is quite straightforward. When companies start expanding their operations, they first spend on factories, equipment, infrastructure, and then the earnings growth comes. So it shows up on the PMI first, and then it flows into the earnings. So in other words, if capital expenditure starts to slow, this PMI indicator is where we're going to see it first, well before it actually shows up in the earnings reports of companies like Nvidia. Now, today, the data is telling a very interesting story and quite different from the headlines. Instead of slowing down, the PMI has actually moved back above 50 and stayed there for the past few months. If you compare the pattern, it looks a lot more like 1998 rather than 2000. So that suggests that we may not be in the late phase of this build-out. And that would make it hard to argue that S&P 500 earnings are about to roll over from here, at least not for another year. And we're seeing real evidence of this on the ground as big tech companies, the hyperscalers have been reporting strong earnings results in the recent quarters. Amazon, Alphabet, Microsoft are all seeing annual earnings growth of roughly 20%, which reflects a massive increase in potential spending power that could go right towards AI infrastructure spending. And that's exactly what management teams in these companies are guiding towards. Their spending estimates have continued to move higher since last year, with projections reaching as much as $800 billion by 2028. So capital is not the constraint here, so it's hard to imagine a classic bubble burst in this type of environment, which is why we are continuing to keep our portfolio exposed to this extremely strong theme as we have in the last few years. Now, the best way to play this is by far semiconductor stocks that are seeing absolutely record earnings growth as a result. We've kept exposure to this sector, and we expect to continue doing so in the next few months. However, we believe that all of this money that is being accumulated is going to start rotating into other sectors that are actually responsible for the raw materials that are needed for all of this infrastructure to actually be built. And these are sectors that are completely overlooked by the majority of investors right now. The first is nuclear power, that is projected to witness a massive increase in demand as larger tech firms have repeatedly made it clear that this is their number one option to generate electricity in order to power AI. Base metals are the second sector that we expect will benefit. Metals like copper and aluminum are already benefiting massively from the AI boom, as they are critical elements for the infrastructure build-out taking place. They've performed extremely well ever since ChatGPT was released, but we think their trends are about to accelerate higher. During the infrastructure boom of the early 2000s, copper prices melted up by 400%. It would not be surprising to see something like this happen again, especially considering that this would be a catch-up to the price of gold that copper often lags behind. And finally, in order to deliver all of the electricity that will be required for AI to run, energy infrastructure stocks will also benefit greatly. These companies are already seeing record earnings growth and putting them on an accelerated path upwards, but we believe they are still very cheap, with some stocks having massive runway ahead. We've selected 6 companies within these 3 sectors that we expect will generate massive returns in the coming months. We've done hundreds of hours of research on these sectors to select these companies, and these are truly exceptional businesses that are heavily undervalued right now. We are already allocating significant capital towards these because we do think they could soon start explosive runs. If you want to access the complete report on these stocks with the full breakdowns of their business models, our price targets, our portfolio strategy for these, you can click on the link down below. Thank you for watching.